Welcome to the Financial Planning Certification Exam Lessons podcast. This is going to be a sample lesson of the full series of audio lessons which are available at the website fplessons.com. That means financialplanninglessons.com, fplessons.com. At the website, you can find the full series of audio lessons. The full series of audio lessons consists of 6 different sections. Those sections include general financial planning principles, professional conduct and regulation, insurance planning and insurance products, investment planning, tax planning, retirement savings and income planning, and finally estate planning. A total of 6 different sections. You can buy the individual sections at the website fplessons.com. All right, let's get on to this sample lesson. This is audio lessons for the Financial Planning Certification Exam. This is Part 3, Investment Planning, and this is lesson number 2. Over the next several lessons, we are going to be covering fixed income investments in their various forms, and this first lesson is going to be about money markets, and that includes T-bills, commercial paper, and so forth. And then we're going to be moving on to government securities, municipal securities, and corporate securities and convertible bonds. Now, for a lot of you that have passed the SIE exam, the Series 7 exam, the Series 65 exam, or the Series 66 exam, this may be review. I'm including it in these lessons because you need to understand it. If you already understand it and you're confident in your knowledge of these investments, you can skip this over. But it may be included in questions on the exam, so we are going to include it here. But for a lot of you, it may be review. So let's get on to the first lesson in this series of lessons on fixed income investments. So first of all, what are money market funds or money market instruments? Well, they are debt obligations which mature in 1 year or less. And these could be long-term fixed income investments, but time has gone on long enough that they're going to be maturing in 1 year or less. So anything with a maturity of 1 year or less is considered a money market instrument. Institutions who trade in money market instruments usually trade in large increments, $1 to $5 million or even more. And typically, most money market instruments, which are mostly Treasury bills, is the most common money market instrument, but they trade at a discount to par, and then they mature at par. But there are some, and these would be the bonds or fixed income investments that were issued with a face par value. They would trade at basically at par plus accrued interest. So that's how money market instruments are typically traded. The most common money market debt, again, is Treasury bills. And then again, any Treasury securities. Most common money market debt are Treasuries, direct Treasuries. So you got the bills, the Treasury notes, and bonds which mature in less than a year or a year or less. Another type of money market debt is called a banker's acceptance. And a banker's acceptance is simply a security which is used to finance imports and exports. And a banker's acceptance is basically a draft by a bank payable at a future date, which is guaranteed by the bank at a specific interest rate. And these are typically short-term in nature. So that is a type of a money market debt. And a bank is obligated to pay the money out on a specific date in a banker's acceptance. Trouble with banker's acceptances is they're an illiquid market. There's not really much of a secondary market for banker's acceptances. So people that buy banker's acceptances usually hold them to maturity. And there's only one type of banker's acceptance that the Federal Reserve will buy, and these are called prime banker's acceptances. These are issued by the highest rated banks are called prime bankers acceptances. Then repurchase and reverse repurchase agreements are types of money market funds, and we'll talk about those in a moment. And then commercial paper. Now, commercial paper is issued with maturities of 270 days or less. You won't see a commercial paper issued at greater than 270 days, because if it were, it would be required to register, and that would add in a whole additional cost to the issuance of commercial papers. So they are issued with less than 270 days or less in maturity. And then the last type of money market debt is called negotiable certificates of deposit. Let's talk about what repurchase agreements are. Repurchase agreements are simply, and these sort of confused me for a long time, so I can understand why you might be confused about this, but there's traders that trade specifically in repurchase agreements. And a repurchase agreement is simply an agreement between two parties where one party agrees to sell a block of securities to another party with the agreement that those securities will be repurchased at a later date at a specific price, and that specific price will include a yield. Now, these are commonly used with government obligations between primary government dealers. The interest rate on repurchase agreement tracks the federal funds rate, but it's lower because these are considered secured transactions. So the interest rates on repurchase agreements is very low. You as an individual probably won't get involved in actual repurchase agreements, but you need to understand what they are. And repurchase agreements can be as short as overnight obligations. Now, they don't have any liquidity risk because there's an agreement and they're secured by government obligations typically. But they do have purchasing power risk because if the interest rate changes, then that would affect the purchasing power. An interest rate can change overnight, as short as overnight. Now, a reverse repurchase agreement is used primarily by the Federal Reserve, and a reverse repurchase agreement is where the Federal Reserve sells government paper to a dealer with the agreement to buy it back at a later date. And this is called a matched sale. Let's talk about what the Federal Reserve is and does. Now, the Federal Reserve is a private organization. Now, this is something that it seems that most politicians don't even understand this, but the Federal Reserve is a private organization. It is owned by the member banks. The member banks own the Federal Reserve. The Federal Reserve has the monopoly of creating money. The Federal Reserve creates money out of thin air. It just electronically creates money or prints up money, but it has the monopoly power of creating money. Now, the Federal Reserve is owned by the member banks. And what does that mean? That means the stockholders of the member banks are the actual owners of the Federal Reserve. It's not a U.S. government agency. It is a private organization. Now, the President of the United States has the authority to appoint the president or the chairman of the Federal Reserve Board, but the member banks elect the governors of the Federal Reserve. All the money that the Federal Reserve makes is refunded back to the U.S. Treasury, but we don't know what that is because there's never really been a full audit. That's just an editorial note. Now, the Federal Reserve has the ability to create or contract credit in the economy. And the way it does this is through its open market operations. So the Federal Reserve can expand and contract credit by either buying bonds on the open market. So the Federal Reserve creates money out of thin air, goes out and buys bonds or notes or bills on the open market, and this can be from
member banks. It can be anybody. That's why they're called open market operations. But typically they deal with specific government dealers, the largest banks, because they're dealing in such large numbers. So if it wants to create credit, it will go out and buy debt. And by doing this, what this does is takes debt out of the market, puts it onto the Federal Reserve balance sheet, and now we have excess cash in the market, in the economy, looking for places to go. So that's how the Federal Reserve creates liquidity in the market, by buying bonds, money that had been locked up in fixed income investments in treasury bills, treasury notes, or eligible securities, is now free to seek a new home. On the other hand, if it wants to restrict credit, the Federal Reserve will sell bonds or fixed income investments, and this will take liquidity out of the economy. Now, there's certain instruments that the Federal Reserve trades in the open market committee. These are called eligible securities. And typically, eligible securities were considered only the safest instruments, and these included treasury securities, treasury bills, bonds, and notes. But after 2008, this idea of eligible securities was expanded greatly, and now that includes some collateralized mortgage securities, such as those issued by Ginnie Mae or Fannie Mae. The Federal Reserve expanded what it would buy drastically when banks seized up. And this was a way of creating liquidity in a market that really was not working. Prior to 2008, this was unheard of. Federal funds is a common term you're going to hear. And federal funds are funds which a member bank, and this is a member of the Federal Reserve banks, leaves on deposit at the Federal Reserve. Now, banks are required to have reserves which match liabilities, and the reserve requirements are set by the Federal Reserve, and they raise or lower these reserve requirements in conjunction with their open market operations to tighten or create credit in the market. The reserve requirements change from time to time, and banks are required to meet certain reserve requirements. And if the reserve requirements are not met, banks may borrow from other member banks who have excess Fed funds at the Federal Reserve at overnight rates. And the overnight rates are called the federal funds rate. And the effective overnight rate is the daily average of many member bank rates. So that is what federal funds are. What are Eurodollars? Now, Eurodollars is spelled as two words or one word. So Eurodollars or Eurodollars. Doesn't really matter, it's still the same thing. Eurodollars are simply dollar-denominated deposits which are held in bank branch outside the United States. And these deposits are left with the bank for a fixed term, and this term ranges from 1 day to 5 years. Typically, corporations leave these deposits at branches of banks where the branches are located outside the United States. Now, banks can trade these Eurodollars instead of Fed funds to meet the reserve requirements. But the difference between Eurodollars and Fed funds is that these Eurodollar loans can be longer than overnight periods.
And the rate for overnight Eurodollars used to be called the London Interbank Offering Rate, LIBOR, but in June 30th, 2023, it changed to a new rate, and that new rate is called the Secured Overnight Financing Rate, or just SOFR, SOFR.
And the rate for Eurodollars loaned overnight is called the London Interbank Offered Rate, or LIBOR, LIBOR. And LIBOR is an average of Eurodollar loan rates of 5 major banks, which are all located in London. Certificates of deposit issued by brokers. Now, typically banks issue CDs with a maturity of 1 year or less, but brokerages may buy longer-term CDs in large increments from banks, and then break them up into smaller chunks, typically $10,000, and issue them to the customers of the brokerage firm. Now, there's a big difference when you're buying a CD from a brokerage firm versus buying a CD from a bank, and you need to make sure that if you do sell your clients CDs, and you will have clients that need CDs on their portfolio from time to time, but you need to make sure they understand the differences between buying a CD directly from a bank or buying a CD from a brokerage firm. First of all, you need to let them know that their CD is subject to market risk. There's no guarantee that if your client needs to sell that CD prior to maturity, what he's going to get for that CD. In other words, think of a CD issued by a broker just like any other fixed income investment that the broker sells its client. If the client needs to sell that CD prior to maturity, that value of that CD is going to be determined by interest rate risk and also to a great degree by liquidity risk. There's a very limited secondary market for CDs. And in fact, in the few times that I've had to sell CDs prior to maturity, even though interest rates had dropped down and in theory the value of that CD should have gone up, usually I've never seen much of an increase in value in a CD on a secondary market just because there is such a limited secondary market for CDs. Now, on the other hand, if interest rates go up, I have seen a decline in the secondary market for CDs. So it seems to be a one-way street in my experience on the value of CDs if you need to sell those on the secondary market. So your client will not have a pre-penalty. There's no such thing as a pre-penalty risk on a CD because the value of that CD is always determined by the market. Now, if it's a callable CD, they have callable CDs just like callable bonds. It may be subject to reinvestment risk. And a big thing they need to understand is it may or may not be FDIC insured, and this depends on how the CD is held. If the CD is held in street name, then it will not carry insurance. If it's held in the customer's name, it will carry FDIC insurance just like a CD held at a bank. But if you're holding this CD for a client and it's not issued specifically to that client in his name, it will not carry FDIC insurance. Thing that I've seen is when I've sold CDs to my clients is if interest rates go up, the value of the CDs on the client's statement will go down. CDs will be priced at the market value on client statement. And I found that the market value is pretty questionable on the statements. In theory, if interest rates go down, the CDs should go up. I've seen CDs priced at a premium because interest rates have gone down on the client statement. Yet when I've gone to sell those CDs in the actual market, I have not been able to achieve those prices that are quoted on the client statement. On the other side, I have seen the decline in the value of CDs on the secondary market. So the market value that is shown on the statement is a mathematical market value derived from some algorithm. It may or may not reflect the actual true market value of those CDs. And this is sometimes confusing to a client as well as the broker. If it's an adjustable rate CD, the current rate may not reflect the actual market rate. There's some types of CDs that are indexed to the Standard & Poor's 500, and typically they work like this. So you're going to get a certain percentage rate on your CD, and they're typically issued in maturities of at least 3 years and longer. But let's say it's a 3-year CD. You may get a interest rate, let's say, of 3%, where the actual market rate for that CD, if you bought a direct CD, might be, say, 5%. But for that lower interest rate, you may have a participation to the Standard & Poor's index or the Dow Jones index or any number of indexes. And if the market goes up or the index goes up, then you may receive a greater return on your investment than the interest rate because of the increase in the market. typically there's a cap on how much these CDs can go up. So let's say you bought a CD and the market went up 10%. There might be a cap of 8%, so you would participate up to 8% on the increase in the market, but no further. But if the market went down, you would still receive your interest rate, which is lower than the market interest rate at the time. There are risks with these. You need to make sure your clients understand the risks of these type of CDs. Well, that's the end of this lesson. Keep studying.